Welcome to another edition of our More Than Market series. My name is Shalon Williams, Director of Investment Management Services at NEI Investments. So last week, June Zimmer discussed how responsible investing can help you reframe your client conversations to focus on the broader impact of investing. Today, I'll tackle a topic that is likely on the minds of most investors these days, and that has to do with inflation and rising interest rates. So inflation is a topic that has been spoken about a whole lot, simply because of the direct impact that it has on consumer households and the erosion of purchasing power. But we think it's more so a topical issue because it will be guiding central bank action as to how soon interest rates will have to increase and possibly by how much. So recently, the US headline consumer price index rose by 7.5% in January, and that was year on year. And that was the fastest increase that we saw since 1982. And that reading really came out marginally higher than what most analysts expected. The main drivers were food, electricity, and shelter. And these are items that are essential, where consumers are not really able to sidestep the way they could have sometime last year, where inflation was more so driven by the reopening components. So what we're seeing now is that inflation is really hitting the pocketbook for consumers really hard this time around. In terms of the month-on-month basis, US CPI was up 0.6%, driven by shelter, household furnishings, medical care, apparel. So there has been a clear broadening out of inflationary impulses, if you may. You may ask, what has been driving inflation higher? And it really boils down to a mismatch of supply and demand. So we have a situation where demand is healthy, but supply is just not able to keep up with the demand. Then the rotation of spending towards goods instead of services, and coupled with, the capacity constraints of US producers trying to increase production, but just not having enough workers on staff to do so. So those are some of the factors that are pushing inflationary impulses even higher. So that really shapes the context of what has been happening in the US, what has been happening in terms of the inflationary impulses. In terms of what it means for the market, following the release of the inflation numbers, we saw where equities declined, Treasury sold off, and the US Treasury curve flattened. And a flattening of the curve simply means that the short end of the curve rose at a faster pace than the longer end yields. And what is essentially happening is that the market is repricing or reassessing a possible more aggressive central bank reaction to inflation. And we're seeing in the Fed funds futures market, where market participants are increasing the probability of a 50 basis point rate hike in March relative to a 25 basis point increase. And that expectation was really encouraged by a Fed member who said that the central bank should raise rates by 100 basis points over the next 3 meetings. So that type of narrative really sent markets tumbling when the pronouncement was made. But so far, most Fed officials haven't sided with that 50 basis point rate increase in March right out of the gate. So that makes us think that the likely path will be a longer series of 25 basis points hike instead. Nonetheless, we think that the Fed will likely be very cautious in not raising rates too aggressively, because that would have some fallout impacts on the economy. And in this environment where inflation is running hot and rates are rising even higher, there's still areas in the investment universe that is well positioned for this type of environment. For example, within the equity space, companies with good cash flows, strong balance sheets, and very good pricing power are positioned to do very well. So this type of environment favors your financials and your energy, which is more of a value play. And in terms of bank stocks, they are good dividend payers and are expected to do very well as rates continue to rise. And then in the fixed income space, our global total return bond fund is well positioned for this environment, given the various levers available to our portfolio managers, such as inflation protect or inflation-linked bonds, going under rate duration, or purchasing credit default swap protection in order to mitigate some of that credit risk. So while 2022 has proven to be a very tough year for financial assets, there are still pockets of opportunities for investors. The key at this time is to have good investment discipline and staying true to your long-term investment objectives. Thank you for tuning in, and I hope you found this discussion helpful. Watch out for our next week's edition of our More Than Market series. And as always, reach out to your NEI representative with any other questions that you may have. Thank you, everybody, and stay safe.